Hey, good morning, everyone. Marty Missouri here, Friday, the 21st of October, 2022, with your economic update for the week. I'm going to do it backwards today. I'm going to do this one first with you, and this one's going to be very quick, I promise. And then I'm going to circle back tonight at the earliest, maybe even as late as Sunday, given commitments this weekend, with a deep dive into markets. So the normal stock market snapshot, I want to talk about currencies. I want to talk about fixed income. I'm going to talk about developments globally that may be suggesting there's some under the surface cracks forming that I think is really beginning to get the attention of Fed governors, which could sway the commentary going forward, which of course has market implications and so on. So I thought, having just updated our index, I'm just going to take you through the handful of data points, make some brief commentary on each, and keep this one just to a few minutes, and then circle back with something more robust later on tonight or over the weekend. So in front of you is our PWA index. It didn't move. It's still rounded up. It's still a -7, which says we are in a setup that says odds favor recession going forward at some point in the not too distant future versus continued expansion. The inputs I want to share with you this morning, several have to do with housing. Mortgage applications, of course, at a 7% 30-year fix continue to fall off a cliff, as you can see here. U.S. housing starts rolled over in terms of the number versus the previous month, and that was all reflected in single-family housing. Multifamilies hanging in there quite well, as you might imagine, the rental market. Housing permits actually kicked up a little bit month over month. However, that was all about multifamily housing. Single family actually had a smaller increase versus the previous month. So again, to the extent that we're seeing decent things in housing starts and permits for the moment, it has to do with multifamily or the rental market. The homebuilder sentiment is just falling off the proverbial cliff. We are way down, 2012 levels here. Again, you see it in the permits, you see it in interest rates. We don't have a 2008 setup from a credit market perspective or a consumer debt perspective, or from an inventory perspective, quite frankly. Some might argue with that in terms of what may be on the horizon from an inventory perspective, but that's not necessarily what I'm finding. So I actually see, frankly, when you look at inventory relative to demand and all these metrics that we get into, housing is at risk for a rolling over in terms of its prices. Do we have this big systemic crash afoot? I know at least one macro analyst who says yes right now. We disagree with that narrative, although we do think there will be continued pain, as does home builders in the months to come. Industrial production, surprisingly maybe, actually rose this last month again. So that's really flying in the face of sentiment. If you look at the manufacturing PMIs, they are just rolling over. So a lot of concern in the manufacturing space. When you talk to the purchasing managers, however, the actual hard data continues to look okay on a year-over-year and a month-over-month basis. As for inflation, market-based expectations, CPI swaps have actually turned back up the last several weeks, 10-year at 2.78. So that suggests that the market expects go-forward inflation to be higher versus what they were discounting previously. However, when we look at things like industrial materials prices, they continue to roll over very, very hard. We are seeing inflation in some key areas of the economy beginning to roll over, and it makes great sense. However, that sticky stuff like wages continues to really pull against any rapidly falling inflation narrative. Has inflation peaked? Sure, I think so. Will it decline going into next year? Of course, I believe so, if we're right about the economy. Will it be 2%, save for in a deep, scary recession type situation? No, certainly not in any sustainable way, I think for years, if not decades to come. And that definitely influences where we think we're going to make money in the years/decades to come. And then lastly, the Baltic Dry Index, cost of shipping bulk goods across the world's oceans, ramped back up here, was falling, showing us, again, a deflationary signal. So this either speaks to tightness in that supply chain, so to speak, although we've seen things open up, and or a pickup in global industrial activity, like we saw in the U.S. industrial production number. I do expect this thing to show maybe some more upward momentum, although it's getting back up here to a pretty high historic level. When China begins to open back up, of course, that is an inevitability. It's a when, not an if, and that has to do with the COVID-0 policy and so on. And I think China's going to come to the market with some catch-up stimulus, or with some serious stimulus with some catch-up in mind. And that is also an influencer in terms of our mild recession thesis that I keep talking about. It has to do with the consumer, it has to do with international developments, it has to do with where we think other countries are in the business cycle. We think that presents some support for ultimately a relatively mild by historical standards recession, and some serious macro opportunities as this bear market finally shakes out what's left to shake out here. So that's it. I'll leave it there for the economic update for the week, with something more robust coming your way within the next 72 hours. Thank you as always for watching and listening. I'll talk to you very shortly. Take care. Bye-bye.